Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage, and welcome to another edition of Java with Jared. Hope you guys are doing fantastic. Well, the NCAA tournament has begun, and so has the March Madness. And actually, in the financial markets, we saw a little bit of March Madness going on ourselves. In the NCAA tournament, yesterday, Thursday, there was a number of upsets, and also the financial markets got a little bit upset on Wednesday due to the Federal Open Market Committee meeting, or actually what Janet Yellen said after that meeting during her testimony. And I'll get to that in a second. But interest rates finished the week a little bit worse than where they ended last week due to what happened on Wednesday. First, with the economic data, we saw, as always, quite a bit of economic data released. We saw the Consumer Price Index come in, and the Consumer Price Index measures inflation at the consumer level, which is always something that the market really likes to follow. And for quite some time, we've seen no inflation, and these numbers, again, show that. The headline number came in with only an increase of 0.1%, and the core rate, which strips out the volatile food and energy component, that also showed just an increase of 0.1%. We saw a lot of information come out on the housing front. We saw existing home sales come in, and that was a little bit weaker than expected at 4.6 million units. There was 4.62 million units last month, so a little bit weaker. The median home price also came in at $189,000, and that was actually up, showed some appreciation. The year-over-year numbers, that was up about 9.1% versus where it was a year ago. We also saw the North American Home Builders Association. They have a survey that is done every single month, and it measures their sentiment based upon sales and traffic and expectations for the next 6 months. Anything above 50 shows some positive feelings. Anything below 50 is negative feelings, and for the second month in a row, it's negative. Yes, last month it was at 49%, or not 49%, but the number was 49, and this month it came in at 47. So again, it's showing builders are a little bit less optimistic. Again, though, as I talked about, the big number or the big market mover for causing interest rates to get worse this week is because of what happened after the Federal Open Market Committee meeting. Now, the Fed met on Tuesday and Wednesday, and then they released their policy, and then there's a question and answer period with the Fed chairman after that meeting. The policy was basically as expected, which they said that they're going to continue to taper, so there's going to be another $10 billion of mortgage-backed securities and treasuries off the table. So we started at $80 billion every single month, and now we're down to $50 billion. And that was just as expected. And they also did remove some of the verbiage that they had in there where not only is there tapering that the Federal Reserve is doing right now, but there's also the expectation that they're going to start raising the Fed funds rate and the discount rate at some time in the future. And they had said that, and this was way long ago, that if once the employment rate reaches about 6.5%, that's when the market could expect that the Fed funds and discount rate would be increased. Now, it's been speculated for quite some time that they'll remove that verbiage because we are basically almost right at that 6.5% level of unemployment. We're just a little bit, above that. We're getting close, and the economy still really isn't doing that great. So no one expected them to raise the Fed funds and discount rate at that point. So they removed that verbiage, and that was as expected. But where the real surprise happened was when there was a question and answer period after the Federal Open Market Committee. Someone asked Janet Yellen, hey, how soon after tapering stops would you start raising interest rates? And she said a very specific number. She said about 6 months. So then all the math and speculation was out the window. Well, all the math started, all the calculations, all the speculation was out the window because we're tapering at $10 billion per month, so we're at $50 billion right now. So in 5 months, we'll be at zero and the tapering will end. And then 6 months after that is when the Federal Reserve will start raising interest rates. And so that would put it at about a year. So all the market, both the stock market and mortgage-backed securities market, which usually move conversely, they both sold off big time, and we got hammered at every financial market across the board because now the markets had a number. About a year is when the Federal Reserve would start raising interest rates. Now the reality is all bets are off on that. That's just a number that she threw out there. So there's no reason to think that for sure in a year interest rates are going up. because it's really going to be based upon what's going on with the economy. And my guess is that we'll see over the next couple of weeks maybe us claw our way back. And already on Thursday and Friday, we're seeing interest rates recover just a little bit. We still have a long way to go from how bad it was on Wednesday, but we're trying to move our way back. So that's what happened with interest rates. We'll keep you informed with what's going on next week, and if the madness will continue. In the meantime, if you ever have any questions, please give us a call, and hope you enjoy the rest of the basketball that's going on. So have a wonderful weekend. We'll talk to you soon, and give us a call if you have any questions. Thanks for joining me with Java with Jared. Bye-bye.